Hey, it's Linus here. In this How I Made $2 Million in the Stock Market summary video, I'll be sharing with you some of Nicolas Darvas' trading rules and Nicolas Darvas' trading strategy. These are the trading rules and trading strategies that Nicolas Darvas used to make, as you guessed it, $2 million in the stock market. So a quick point to take note over here is that you shouldn't cherry pick Nicolas Darvas' trading rules and trading strategies. Nicolas Darvas used all of these trading rules and trading strategies together to make the $2 million in the stock market. So if you want to emulate his success in the stock market, you want to follow all of these trading rules and trading strategies that Nicolas Darvas shared in his book and not cherry pick them. Right, so with that out of the way, let's begin. So first we'll take a look at who Nicolas Darvas is. So Nicolas Darvas is a full-time dancer who traded in the stock market during his downtime. Because as a dancer, in between his performance and rehearsals, Nicolas Darvas had a bit of time to trade in the stock market. So you could say that Nicolas Darvas was almost like a part-time trader. But as a part-time trader, Nicolas Darvas managed to make $2 million in the stock market. And if you take into account inflation, that is more than $10 million in the stock market in today's money. So not too shabby from a part-time trader in the stock market. Now, let's take a look at the trading rules and trading strategies that Nicolas Darvas used to make $2 million in the stock market. So let's take a look at the first Nicolas Darvas trading rule, which is don't listen to tips and rumors from strangers, advisory service, and brokers. Basically, don't listen to tips and rumors from anyone, even from Nicolas Darvas himself if he was alive today. Nicolas Darvas' first trading rule came from his own personal experience. He started out listening to tips and rumors from strangers, advisory services, and brokers. And he has this to say, no matter how rich, experienced, or knowledgeable these people might be, you don't want to listen to tips and rumors from them. So even if these people who are sharing the tips and rumors have the best intentions, they might be investing or trading with a different strategy from yours, or they might be investing and trading on a different time frame from yours. So even though those tips and rumors might be good for their individual trading strategy and individual trading time frame, it might not necessarily be good for your own trading strategy and trading time frame. And that is why you don't want to listen to tips and rumors. Earlier on, I said that most people sharing these tips and rumors might have the best intentions, but not everyone has the best intentions. So let's take a look at what this means. So over here is an excerpt from Nicolas Darvas' book, How I Make $2 Million in the Stock Market. So if you take a look at this sentence over here, it took him years to realize that when these financial tipsters advise the small operator, so the small operators are people like you and I, those professionals who have bought the stock much earlier on, inside information are selling. So while these financial tipsters are telling you to buy, they are actually the ones selling it to you. And if we continue on, simultaneously with the withdrawal of the inside track money, the small sucker money is coming in. So the small sucker money belongs to those people who listen to tips and rumors and act on them. So Nicolas Darvas mentioned that these people are not the firstest with the mostest, but the lastest with the leastest. They are far too late and their money is always too small to support the stock at its false high point once the professionals are out. So I think this is a really important point to take note. If you just go onto the internet and do a quick search, you'll see how many big financial institutions are providing buy and sell ratings. And I never ever trust these ratings by these financial institutions. Because most of these financial institutions, when they're upgrading their buy ratings for a stock or a company, these are the very same institutions unloading their shares to the unsuspecting public. And guess what? When these financial institutions upgrade the ratings for a stock or a company, and the unsuspecting public buys into the stock, we see that very soon the price of the stock that the company just upgraded will tend to decline substantially after that. Right, because the only people who are left in the stock are the unsuspecting public. And their money is always too small to support the stock at its false high point. So as an individual small-time investor and trader, what do you want to do? You want to listen for ideas but not for advice. When these financial institutions or people share their tips and rumors with you, use these stocks that they share with you as stock ideas. So with ideas, you always want to validate them before you act on it. But for advice, you are just following the advice without validating the advice at all. And that is the difference between ideas and advice. And for ideas, when you validate them, you are also doing your own due diligence. Right, so for Nicolas Darvas' first trading rule is don't listen to tips and rumors. The next lesson from Nicolas Darvas is combining fundamentals and technicals. So Nicolas Darvas called himself a techno-fundamentalist. He doesn't just rely on one or the other, right? So he combines both the fundamental and the technicals. And right now I want to highlight a very important point for you to take note over here. This is something that a lot of people get confused over. A good company does not make a good stock. Okay, so let that sink in. A good company does not make a good stock. If the company has strong fundamentals, we usually will call the company a good company. But a good company does not make a good stock. Now then you might be asking, Linus, what makes a good stock then? So a good stock consists of strong fundamentals of the company and strong technical action by the stock. And that is the difference between a good company and a good stock. So let's take a look at Nicolas Darvas' own experience when it comes to fundamentals and technicals. So we'll take a look at an excerpt from the book. We'll read and start over here. So Nicolas Darvas mentioned that it would be difficult for anyone to conceive the shattering effects of the blow. If I had been a wild gambler, I could have expected such a position. But I had done my best not to be one. I had labored long and hard. I had done everything possible to avoid a mistake. I had researched, analyzed, and compared. I had based my decision on the most trustworthy fundamental information. And yet, the only result was that I was wrecked to the tune of $9,000. And he continued on asking, what I asked myself was the value of examining a company reports, studying the industry outlook, the ratings, the price-earning ratios. The stock that saved me from disaster was one about which I knew nothing. I picked it up for one reason only. It seemed to be rising. During the early periods in Nicolas Darvas' experience in the stock market, Nicolas Darvas only relied on the fundamentals. But he wasn't very successful in that period. In fact, he was losing money in that period. So what changed it all for him? It was when Nicolas Darvas combined both the fundamentals and technicals of a stock, which really allowed him to have the success he had in the stock market. If you want to know the technical and trading strategy that Nicolas Darvas used to trade in the stock market, I have a video on the top right of the screen explaining Nicolas Darvas' box trading strategy in greater detail. You can check out that video over there. So the lesson that Nicolas Darvas learned was a good company does not make a good stock. So when you're buying a stock, you want to buy on the fundamentals and technicals. And when you are selling a stock, you just want to sell on the technicals alone. So buy on fundamentals and technicals and sell on the technicals. And that is Nicolas Darvas' second trading rule. The third trading rule that Nicolas Darvas followed was that he mentions that you don't have to be right all the time to be profitable in the stock market. He even mentioned over here that you can be right only 50% of the time and still make big money in the stock market. How is this possible? Well, it's possible if your average gains is greater than your average losses. So how do you calculate your average gains and average losses? First, you have to gather all of your past trading results. And from those results, find the total gains that you made in that period, divided by the total number of winning trades, and you'll get the average gains. And for average losses, you have to tally up your total losses divided by the number of losing trades. So after you have calculated those figures, you want the average gains to be greater than the average losses. This is an example of some of Nicolas Darvas' trades. So as you can see over here, I calculated the gains he made on each trade. So for the first trade, he made 24.1%. The second was 20.5%. The third was 11.19%, 8.69%, 4.96%, 8.07%, and 6.72%. We could roughly estimate that Nicolas Darvas' average gains was around 8 to 10%. And if we take a look at his losses, these are some of the losses that he made. So the first one, he made a loss of 4.35%. Then the next one was 1.92%. The next is 2.36%. And the last one was 1%. We can roughly estimate Nicolas Darvas' average loss was anywhere between 2 to 3%. So his average losses was around 2 to 3%, while his average gains was around 6 to 8%. So is his average gain greater than his average loss? Yes, right? And as you have seen, Nicolas Darvas had his fair share of losses. But he was still able to make $2 million in the stock market. And this just shows us one thing. You don't have to be right all the time to be profitable in the stock market. And another important point to take a look over here is that if you notice, the individual percentage gains on each trade is not a very huge amount. And this is another common misconception that people have. When people take a look at how Nicolas Darvas made $2 million in the stock market, most of them will assume that Nicolas Darvas traded in stocks which gave him more than triple-digit returns. But as you can see over here, none of his individual trades percentage-wise was more than triple digits. But the reason why he was still able to achieve what he did was because of compounding. So if you have an edge in the stock market, which Nicolas Darvas did, and you can compound those gains, even though those gains individually might not necessarily be very high, you can still be very successful in the stock market. So that's another key lesson to pay attention to. Let's move on to the next Nicolas Darvas trading rule. So the fourth one is portfolio concentration. For Nicolas Darvas, he only focused his portfolio on only 2 to 4 stocks. And there's a reason why he doesn't want to over-diversify. So let's take a look at an example. Let's say you don't concentrate your portfolio. So you had 20 stocks in your portfolio. And you allocate your capital evenly among these 20 stocks. So you set aside around 5% for each stock. And let's say one of the 20 stocks that you had in your portfolio go up by more than 100%. So how much do you think your overall portfolio will be up? The answer is 5% only. So that's not a lot, right? And how often do you come by a stock which goes up 100% or even more than 100%? Not very often. So if you over diversify your portfolio, even if one or a few of your stocks go up by 100%, your overall portfolio performance will not be very high just because you're too diversified. And that is why Nicolas Darvas chose to concentrate his portfolio in just 2 to 4 stocks. Now, many of you guys might think, if you concentrate your portfolio in just a few stocks, what if these stocks go down in price? Won't that also be more risky for your portfolio? It goes both ways, right? So if you concentrate your portfolio, you might get potentially higher returns, but also at the same time, your portfolio might go down by more. And that is where proper risk management such as position sizing and stop losses come into play. That topic by itself is a huge topic, and that is a topic for another day. But the main lesson that Nicolas Darvas is talking about here is portfolio concentration. And those are Nicolas Darvas' 4 trading rules and 4 trading strategies. Hopefully you guys have learned something and enjoyed this video. If you did, smash the like button because it will really help the channel grow and allow me to produce more content such as this. And if you are new to this channel and haven't already subscribed, make sure you subscribe to my channel because each week I release new videos about investing, trading, and the stock market. I'll see you in those other videos. To your financial success.